All right, let's break down the stock market for September 11th. We saw some absolutely incredible record highs, which is fantastic news, right? But here's the strange part. All of this happened on the back of some really confusing economic news. So, what's really going on? Wow, what a massive day for the market. I mean, just look at these numbers. The S&P 500, the Dow Jones, and the Nasdaq. They didn't just inch up, they all rocketed to new all-time highs. And hey, even the small cap Russell 2000 index got in on the action, jumping an impressive 1.83%. A huge day all around.
So, that brings us to the big question, doesn't it? What's really behind this incredible rally? The economic news was, frankly, a total head-scratcher. So let's play detective here and piece together the clues that drove today's amazing performance. Okay, our first clue dropped bright and early at 8:30 a.m. with the release of the latest inflation data, the Consumer Price Index, or what we call the CPI. Now, at first glance, this number looked a little hot. A 0.4% increase is a bit higher than Wall Street was expecting, and normally that's bad news for stocks. Why? Well, because it could mean the Federal Reserve will decide not to cut interest rates. But this is where the story gets really interesting. Instead of panicking, traders looked right past that headline number. They focused on a different metric, core CPI. You see, the headline number is the one that grabs the news, but the core number, which strips out those wild swings in food and energy prices, that's the one the Fed watches like a hawk to see the real trend. So, what was the verdict? Well, the core CPI number came in exactly as expected. So even though tariffs were pushing up prices on some things, it wasn't the big, widespread inflation surge that some people had feared. The most important thing was the path to a rate cut was still wide open. Okay, so just as the market was digesting that inflation report, bam, another piece of data dropped, and this one seemed even more alarming. New weekly claims for unemployment benefits shot up to 263,000. That's a huge spike, way past what anyone expected, and it hit a nearly 4-year high. For a moment there, it really did cause a bit of a panic, a sign that the job market could be in real trouble. But once analysts really dug into the details, the story completely changed. It turned out this wasn't some nationwide problem. Nope. About 60% of that entire increase came from just one state, Texas. And it was probably tied to a one-time deadline for disaster assistance claims. Phew, false alarm. And this right here, this perfectly explains the market's weird mindset right now. The thinking became, okay, the job market is cooling off a little, but it's not falling off a cliff. And for investors at this moment, that is the absolute sweet spot. It's this world where slightly bad economic news is seen as great news for stocks because it all but guarantees the Fed will step in and cut interest rates. So let's connect the dots. You've got inflation that's manageable and a job market that's showing just enough weakness. The market's conclusion became crystal clear. The Fed is going to cut rates, and traders are betting on it with near total certainty. If you ever want to see exactly what the market is thinking in real time, you can look at a tool called the CME FedWatch. It's pretty cool. It basically tracks how traders are betting on what the Federal Reserve will do next. And whoa, the message from traders is loud and clear. Looking at the tool, they are betting with 100% certainty on a rate cut this month. But it doesn't stop there. The probability of another cut in October is over 90%, and the odds of a third cut in December are hovering around 86%. The market is all in on a rate cut party. So this huge wave of rate cut optimism has Wall Street experts divided. On one side, you have pure euphoria, and on the other, a pretty deep sense of unease. In the bull corner, we've got veteran strategist Ed Yardani. He is so optimistic that he just raised his year-end forecast for the S&P 500. He sees the potential for what he calls a melt-up. That's a sudden, sharp surge in prices that could take the index all the way to 7,000. But then you have Lloyd Blankfein, the former CEO of Goldman Sachs. He looks at this exact same environment and gets nervous. He says things feel too good, and that's precisely what worries him. It reminds him of periods like 2007 and 1994, right before major market downturns. So what's Blankfein's move? Well, this is the interesting part. Even with his worries, he's still 100% invested in stocks. He's not running for the hills. Instead, he's just playing defense. He's shifting into those high-quality tech giants that he believes can weather any storm that might be coming.
And this brings us to the final piece of our puzzle. While the market is celebrating what looks like a clear path forward, there are some really serious risks lurking just beneath the surface. Risks that could change everything. So, what are the experts keeping an eye on? A few things. The US federal deficit is ballooning, even with record amounts of cash coming in from tariffs. There's also all the uncertainty around global trade. And here's a wild card, a potential Supreme Court ruling that could reverse those tariffs. That would force the government to pay all that money back, creating a massive shock to the system, and maybe even chaos in the bond market. And so this leaves us with the final cliffhanger. Is the market's laser focus on rate cuts causing it to ignore these very real dangers? Today was a celebration, for sure, but the question is whether these hidden risks are gathering into these storm clouds of tomorrow.